This is John Persinos, Editorial Director of Investing Daily, with a video presentation for Monday, March 22nd. To view our full range of investment advisories, visit our website at www.investingdaily.com. Stocks took a breather last week, but there's still plenty of fuel to keep the bull market alive. As the economy reopens, earnings rebound, and the Fed stays dovish. The three major U.S. stock market indices pulled back last week in choppy trading as investors fretted that the economy would overheat and ignite inflation. But as I've made clear in previous video presentations, inflation fears are currently overblown. It's my contention that three pillars shore up the bull case for 2021: economic recovery, massive free liquidity growth, and a rebound in corporate earnings. To be sure, unexpectedly bad news concerning the coronavirus pandemic could trigger dips along the way, but that's not likely as vaccination rates accelerate. Regardless, the tailwinds for the stock market, especially from fiscal and monetary stimulus, are powerful. Setbacks in fighting the virus could delay the bull market, but, in my view, not derail it. That said, stocks last week closed lower as the 10-year Treasury yield finished higher for the 8th consecutive week, fueled by rising inflation expectations. Although, as the following table shows, stocks remain in the green year to date. Take a look at the table. Historically, rising inflation in and of itself hasn't been fatal for stocks. The killer blow usually comes when the Federal Reserve preemptively raises interest rates to nip inflation in the bud. However, Fed Reserve Chair Jerome Powell has repeatedly reiterated the central bank's vow to sit tight on rates even if inflation temporarily spikes. After concluding its two-day meeting last week, the Fed continued to project near zero interest rates through 2023. The $1.9 trillion relief plan signed by President Biden this month is not only providing Americans with a second round of stimulus checks, but it's also extending two federal unemployment programs that have kept Americans from becoming destitute during the jobs crisis. The second chart tells the story. According to data published by the U.S. Department of Labor on March 18, jobless claims totaled 770,000 for the week ended March 13, an increase from 725,000 during the previous period. The total was well above the 700,000 consensus estimate. However, the economic recovery appears to be on track. The Philadelphia Reserve's Manufacturing Outlook, released March 18, showed a reading of 51.8, which signals economic expansion. What's a major factor that's been driving stocks to record highs? Massive monetary stimulus courtesy of the U.S. Central Bank as a means to counteract economic damage from the pandemic. The Fed's balance sheet has grown to nearly $8 trillion, as it buys everything from U.S. Treasuries to mortgage-backed securities. See the third chart. Long-term interest rates currently hover at levels that aren't economically restrictive. Meanwhile, the steepening yield curve is helping the relative performance of financials and other economically sensitive sectors. Your best bet is to rotate away from momentum stocks and towards cyclical value plays. Another bullish factor is the breadth of this rally, especially the recent surge of small cap stocks. The rally is no longer inordinately dependent on a handful of mega cap technology stocks. My verdict? The stock market took a hit last week, that's true, but still hasn't reached a peak. Underlying conditions point to further upside ahead. Also keep in mind household savings rates are high. That pent-up cash will soon find its way into the economy as consumers remove the shackles of quarantine. The recent disbursement of new stimulus checks will drive an uptick in consumer spending, which is, after all, about 70% of gross domestic product. Okay, that should do it for today. You know, I enjoy a robust conversation with my readers and viewers, so please, don't be shy. Send an email to mailbag@investingdaily.com. In the meantime, stay safe, stay invested, and thanks for watching.